This class is going to focus on two things: ranged bar entry methods and our intelligent trailing stop. On range charts, the intelligent trailing stop that I use is called the FX Build Your Own Trend. To add it to your chart, you right-click, Chart Settings, and then you go to Add Script, and it's called FX Build a Trend Stop. And these are all the different options. You can watch our video online to see how we set this up, but let me just show you what the settings that I'm using on most of my range charts. It uses some of our best statistical trend tools with the time frame that you're using, in this case the 5-minute bar, the weighting. I give this 20%, 10%, 10, has to add up to 100%. And when you're done, you have a range chart, which I've explained hundreds of times in other videos, but it's, instead of a time-based chart, it's in this case 6 pips per bar. Every time it moves 6 pips, there's a new bar, 6 pips. And you can see on this red bar right here, it opened up, went up a pip, and then came back down 6 pips, and that's the end of that bar. The beautiful thing about range charts are they really can improve your entry, and you most of the time have smaller losses. So when you're wrong, you lose less, and when you're right, you typically have the same and sometimes more profit than you would have before, because we have very tight stops. As you can see, it got you out right here, pullback. If you use these as an entry and exit method, it also does quite well. You can see in at 55, out at 87 for 22 pips in that case. Obviously it's not going to work every time. If you had bought this pullback right here, in at 42, out at 32, you lost 10 pips. But what I find is you can use this in conjunction with normal trading methods we've taught for years, and it allows you to have a smaller loss. Typically I put my stop 1 or 2 pips above or below the previous bar's high or low. So for instance, if I'm buying this pullback right to the hourly moving average, which this is one of our trading systems, you can watch many videos that we have on our site, many classes on buying and using the hourly moving average. But I would go long when it went above this bar's high at 29 and put my stop a pip underneath here. So you can see that's 9 pips. If you have a 2 pip stop in the or 2 pip spread in the euro, you have 11 pip stop there. And in at 29, out at 47. You can see that's an 18 pip profit while risking only about 10 or 11 pips. Anytime your wins are bigger than your losses, you don't even have to be right, even half the time to have a net result of profitable trades. So going through this chart, let me just explain what the trades I would take. Anytime the market hangs around the hourly, up, down, I've found 5 to 10 bars of chopping around the hourly. When it breaks out, that's a trade I like to take. It's very high probability. It's even higher probability when the weekly trend's up. In this case, the weekly trend's down, so I wouldn't trade super high lots on there. But in this case, the trade really panned out. Using our currency meter today, it also showed the euro was strong and the dollar was weak today. You're in at 16, you're out at 57. And you know that the previous day's high rate is right here, and if it stalls there, I typically exit half my trade, and I use the trailing stop on the other half. But if it shoots right through it, like in this case, I'll just exit the whole trade here at 57. You're in this trade, let's just say it's 17, you made 40 pips. Now oftentimes markets will come down. I like to get at least a 15 to 25 pip pullback before I buy. This is extremely strong. Here's the previous day's high. I'd be lying if I said I wouldn't have re-entered right here on this bar. I have a lot of profit to give back if I'm wrong a little bit. You can see that's where my stop will be. It starts to go up, and it doesn't really have that much momentum, and it comes down and stops me out. So when that happens, I'm a little bit more cautious. I might wait for a deeper pullback. One of our methods is a Fibonacci Elliott two-wave system. Typically on the first wave, after the second wave, somewhere between the first and second 1.618 fib target is going to find support. In this case, we have the hourly moving average there. And so I have a nice big win. I have a 5 or 6 pip loss. I go long again here and again have this profitable trade. It pulls back again and finds support at the monthly pivot and the weekly pivots there. So I'm going to buy again right here at 37 and get stopped out with a small loss. And then it's just chopping around at the hourly again here. So typically after about a half an hour, you want to buy the breakout here. It never breaks out. You can see the statistical weakness is now at the downside. There's no strength. So I'm going to short here. I also have my fib target of this last wave to shoot for. It's not that far away, so it's possible that I wouldn't really trade much on this trade. I might trade half or even a third of what I normally do because this is my first profit target. It's also the hold number. Hold number tends to have buying orders there, and so when it comes down here and kind of runs out of steam here, I'm going to get out of half and then let my trailing stop get me out here. I might, because of how weak it was, I tend to draw my trend lines on here. I probably would have gone short again right there. And as it starts to fall back down, we have a trend reversal signal that shows up right here, and it also has 1/2 or 30 or 40% less weakness than it did before. So I'm moving my stop quickly to break even. I'm going to probably break even on this trade. I'm not going to go long down here because the trend's down. So unfortunately, I'm going to miss this move up. And a lot of times, if it goes sideways at the hourly and breaks above it, I'll go long. But in this case, we have resistance above and also the previous day's high. So I'm not taking that trade. But when it chops around, it goes above the previous day's high and it finds support here, I am going to buy this breakout right here of the high. 30 minutes is my minimum. This is extremely strong. It's likely to go up. And it does, but it doesn't go up that much. I probably would have made 10 pips there. And you can see this next pullback, there's no weakness. I'm definitely buying this one, and I would have panned out and made 30, 35 pips on that second trade. One of my favorite range charts trades is find a momentum move up or down and wait for 3 to 5 bar pullback. So this bar right here is a wick. These wicks are oftentimes the reversal points on range charts. It's one of the reasons I love range charts so much, especially at the end of a big move. You see a doji stick up or down like that, it tends to be a reversal. So I wouldn't necessarily count that as one of the red bars, even though it closed 1 pip from where it opened. 1 bar, 2 bar, 3 bar, 4 bar, 5 bars down. I want to wait for 1 green bar, and I'm going to buy it just to make sure there's momentum. I'm going to wait for it to go above that bar's high by 1 pip, and I'm going to go long. So I'm going to go long here at 50. My stop's underneath the low right here, and you can see that this went up. And the upper containment band usually is the end of the move. We have a weekly and a monthly pivot level up here. It does have a lot of strength. I'm probably going to exit half my trade right here at 87 at the major resistance area. I'm going to let the trailing stop get me out of the other half, which probably is about the same price. So you can see that's a 35 pip move. Let's look at another currency. Let's see, the euro. Here's the pound dollar range chart. And this one was quite choppy earlier in the day. But the beautiful thing about these are when trades don't work, you have the smallest of small losses. Now this one has a daily, weekly, and monthly trend that's up. So I'm primarily focusing on buying this. It's chopping around the hourly right here and breaks out. And unfortunately, I'd probably be in here at 13, out at 17, maybe a break-even trade. There's not that much strength right here, and there's also a resistance area right here at the previous day's high at 41. So I don't really want to buy the breakout right here at 33 with my profit target only 7 pips up. That's one of the keys to trading. Focus on trades where the next support or next resistance area is at least 2 times away, more than what your stop is. If you're going to risk 10 pips, then you need at least 20 pips distance. It's like driving on a empty freeway versus driving on LA freeway during rush hour. It's totally different. So some of the trades I might take in this later in the day, it pulled back to the hourly. If it found support here and broke out, I would have bought the breakout, but it didn't. It comes back up to the hourly. And I'm always hesitant to buy a currency when it's been underneath the hourly, but it didn't have that much weakness today, so I probably would have bought this breakout right here. And unfortunately, you can see the price went up a little bit, and from that entry point, my stop moved up. I'm out at 11, I'm in at 16. I lost less than 7 or 8 pips. Buy the next breakout right here at 15, out at 30. And again, most of the time, when I see resistance areas, I will exit half my trade here and the other half here, because I've found that it's psychologically easier to pull the trigger when you know that probably 2/3 of the time you're going to have a small profit on your first half. That's just my own estimation of how often I exit the first half with winning trades. And you can see a lot of statistical momentum, but only on one of the bars. It pulls back and finds support. I like these little double, very close together lows on a range chart. When it breaks out right here, I'm in. And again, stopped out with a 5 or 6 pip loss. I'm going to really wait for it to break out. Usually double tops are the end of moves, and when price comes up again and breaks out, you got to take this trade. It's also the 50 level. If it goes above there, you know, there's usually some selling at the whole and the half numbers coming up to it from below. The fact that it breaks out right here, I'm in, and here's my first profit target. If it stalled right there and went sideways, I would have got out of half, and same thing for here. This is the 3.0 containment band. Usually this is the maximum high. Price rarely goes above this, and when it does, usually within 5 or 10 minutes, it comes down 15 to 25 pips. So seeing this here and it's going sideways, I typically will move my stop right underneath these bars low, and I would have got out here around 95, about a pip or two above where the trailing stop was. But that's a huge win, in at 55, in at 50, 51, out at, let's just say 90. You got 40 pips on that trade. One nice big win like that where you make 4 times more than what you're risking makes up for all the tiny little 5 and 6 pip losses. And as you can see in some of these, you know, crappier trades, if you went in right here at 16, out here at 41, that's 25 pips on the first half, and you know, a little bit less, 10 pips less on the second one. You know, a nice trade like that gets rid of some 2 or 3, 5 or 6 pip losses, and then when you get a nice big win, it's all profit because you're not making up for being down on the day. But if you were down 15, 20 pips on the day and you catch one nice trade like that, it gets it back. Plus you have extra left over. The goal should be 10 pips a day, 50 a week, 200 a month net. And doing that with very low leverage, you can double your account every 2 months. So it doesn't take a whole lot of pips. Keep that in the back of your mind. It makes trading easier. It makes it a lot easier to pass on trades that are not likely to work because you only need 10 pips a day. So you don't want to be down 10, 20, 30 pips today, which means tomorrow you got to make your 30 pips to make up for today's loss, plus 20 for those 2 days. You know, you want to make 10 pips that one day and then 10 the next. You're going to have to make 50 pips the next day to be where you should be in the week. So thinking about trading like that, is this trade even worth it? What's the risk versus the reward? What's the odds of the trade working? How many pips am I likely to make realistically? Avoid the less optimal trades because there's always good ones out there most days. Maybe one day a week there could be choppy markets in all the currencies, but usually that just means the next day is a lot better trading day, a lot more likely to trend, and you can usually make up for your losses the following day after a choppy low volatility day.